Hello, I'm Scott Humphrey, CEO of the World Floor Covering Association. Thank you for being with us today. We've been on quite a few of these Zoom conferences lately, trying to do our best to update you on the latest legislation and everything that's going on in DC and sometimes at the state and local levels. Today, we're going to update you on some new legislation that was passed, the next phase of the PPP loans, and we'll talk to you much about the common questions that are occurring to us. Before we do that, let me give you a little bit of the format of how this is all going to work. Jeff has a presentation he's going to make. He will go through that presentation and then we'll do Q&A. If you look at the bottom of your screen, you have a Q&A icon. That's where you will post the questions that we will ask of Jeff. We've scheduled this webinar for about an hour, but we'll stay as long as needed to answer those questions. We also have Steve Abernathy with us. Steve is the CFO of the WFCA. He typically does a financial aspect of this, but we assume that many of the people on this call have been on before. We didn't want to repeat the same information, so we could dedicate more time to the things that were important to you. But if you have a question related to the market or to the financial stability, everything that's going on in that area, Steve is on the call and available to answer those questions for you. So please feel free to pose those questions as well. We're going to do something we haven't done before, but we want to ask you a question. We're going to put a poll question up. We just would like to find out how many of you are new members to the WFCA. So we'll ask you to respond to that question. And Lewis, you can put that up. And we'll just be monitoring that. We're doing that partly because we're very interested in your response, but also because we want to begin to make these webinars even more interactive between us on this side and you on that side. We do quite a bit of that, and it's somewhat different from a lot of these that happen in the industry because we do have live Q&A, but we realize these issues are important to you and they're important to you now, and you need those answers. So we're doing everything we can to make sure that we give you those answers on a timely basis. So we'll continue to let you do that. I'm going to continue to speak here, but I want to give you a quick update on what the WFCA is doing during this time. Assuming that all of you are members, and maybe many of you have been for some time, some of you hopefully are new members, and we want to thank you for that. If you're not a member of the WFCA at the primary level, that's professional flooring dealers or people in that realm, then we invite you to join us. It's free. We've made membership free to the WFCA so we can speak as one voice at the state and federal level. And so we welcome you to come on board and join us in that. Over the last several weeks, we have literally had tens of thousands of touch points where we have been communicating with you. Some of that direct one-on-one emails, many of those email blasts, social media, blogs, posts. We're doing everything we can to communicate with you, but also to allow you to take that information and share it on with others in the industry. We have no intent of carrying this information solely ourselves. We're all in this together, and so we're sharing that information with other associations, with major groups throughout the industry, and challenging them to rebrand it, do whatever they need to with it, to share it with their membership as well. This access to this information, again, is free and open to everybody, but we really do want to speak with one voice, and the more of us there are, the louder that voice is. If you haven't already visited, please visit our website, www.wfca.org. We have all pertinent information about legislation and everything related to the coronavirus. In fact, when you go onto our site, that's the first thing you'll see is a link for you to click. It's the coronavirus response. And once you go in there, you'll see questions and answers that are commonly fielded to Jeff King, our legal counsel. You'll see information about insurance, information about state regulations on who can work and who can't, all types, anything you can imagine, not only for the United States, but also for our members north of the border in Canada as well. So please take advantage of that. Refer back to that site on a regular basis. We're updating it constantly. We have an amazing partner in Washington, D.C. named Lobbyit. That's our lobbying firm that we've partnered with for years, at least since I've been in this role. Jeff has a longer relationship with them even than I do. And Lobbyit has been really good at getting information to us on a timely basis. In fact, often we get the legislation before it's finally voted on, and we're allowed to give input to that. And so Jeff quite often speaks on your behalf to Lobbyit, who then carries that information to the pertinent parties that can make sure that our voice is heard long before things are voted on. And so we want to thank Lobbyit for their involvement as well. One other thing before I turn this over to Jeff King, we have made utilization of our online university free through June 30th. So if you're looking for something to do in the downtime while you're still impacted potentially by stay-at-home orders, certainly go to our website again and log on to WFCA's online university, and you'll see a plethora of videos there that can help you from sales to back office management to leadership. And those are free to use so that you can get a taste of our university during this time when we're all somewhat in forced isolation. We want you to be able to utilize that time to make yourself better. So normally this is where I'd introduce Steve, but I've already done that. And again, I'll make you aware that if you have questions on financial basis, Steve's available. But this time I want to turn it over to the star of our show, and that's Jeff King. Jeff is the legal counsel for the WFCA, a role that he has been in for over 20 years. Jeff practiced law in Washington, D.C. He is the principal with J. King Law and Associates, and he can fill you in on much of what's going on in D.C., and you'll hear some of his expertise in just a moment. I do want to remind you, Jeff is obviously not licensed to practice law in all 50 states, nor is he licensed to practice north of the border. So we provide you information so you can take that information and go back to your team, your experts, your legal and accounting teams, and find out specifically what you need to do in your area. Oftentimes there are local regulations, state regulations that may differ from what we typically communicate at the federal level. But Jeff is an amazing expert, probably more so than anyone in the industry right now. And I've got to tell you, he has worked tirelessly to respond, not only in these webinars, but to every individual who has emailed and asked for a response. They got it. Now, I say that, please don't just email Jeff, because probably your response is already on our website under the frequently asked questions. Please go there first. But if you don't find the answer you're looking for, Jeff has been amazing in responding to those. So Jeff, I thank you in front of all these people for your willingness to step it up even far beyond what you were doing before. And I turn it over to you.
Thank you, Scott. We're going to go through a very brief PowerPoint just to bring you up to date, focus on the new developments. If you put it up, Louis, I appreciate it. As you can see, it talks about new money, new rules, new programs, new obligations, and new problems, and I really mean that. I want to make it quite clear to you all, however, that I will answer questions on anything you need within my purview of understanding and knowledge. But we just, this morning on the PowerPoint, I'm just going to sort of focus on what's happening. Next slide, Louis. And the biggest development is that there's been additional grants and loan programs available. I want to make sure you're all aware of them. As you know, the second CARES Act was passed. It added $320 billion to small business loans. It set aside a number of those loans for smaller banks, credit unions, and lenders, and that was to ensure that smaller businesses could get access to it, so the large banks did not gobble it up for their larger clients. The rules have been clarified a great deal. You must spend the money that you get from the loan in the immediate 8 weeks after the loan. It set up new rules for sole proprietors and LLCs to explain how best to apply for those and what documentation you need it. And they've added some new regulations and restrictions on whether you need the loan or not. And they're really going to look at your reserves and whether you had access to other funding. That is probably only going to apply to public corporations, the type of corporations that you all been hearing about in the news, you know, like Shake Shack, etc. Be aware that the Federal Reserve also has a new loan program out. It's called Main Street Lending Program. It gives loans of $1 to $25 million. The idea is to retain 90% of your employees. You can that is a straight loan. It's got an interest rate of about 4%, I believe. It's a little under 4%. You can get both a PPP loan and a Main Street loan, so you can get them both. So after this 8 weeks, you may be looking at some additional needs to carry you through until everything gets back to normal, if it ever gets back to normal. And this may be another program. There's also, as we mentioned in our last webinar, there are state programs, some local city and county programs. You need to look at all of those programs. They may provide you with the financial needs you have. Next slide, Louis. I wanted to talk about, though, now that you're starting to see shelter-in-place orders being eased or reconsidered or completely removed, and you're starting to reopen, you need to consider certain things. One, you're going to have obligations to your employees and their customers to keep them safe. So what we've done is we've gone through the CDC recommendations, the OSHA guidelines, state and local rules. We've looked at other associations and group proposals, all sorts of things to sort of identify what those basic recommendations are to ensure you're are in compliance with them and to minimize any risks you have. There's also some reporting requirements and limits, and we wanted to reconnect back with the sick and family leave requirements under the Families First Act, because they will come back into effect as you start bringing people back on. Next slide, Lewis. So what I've provided here is just a sort of a short list of what you should be doing when you start to open. I'm not going to go through them all. Some of them are obvious. I do want to let you know that yesterday, WSA posted a very detailed list of this with a greater explanation of it. And in fact, I think there's 15 items in there. We've expanded a little bit. I couldn't fit 15 on this page, so you get 12 of them, and some are combined. But they're explained, they're available there, they explain, they're important. And they're important is one of the questions we get a lot of is, will I be liable if an employee gets sick or my customers get sick? And the answer is possibly, but way to minimize that liability is to show that you took the proper precautions. Because remember, you're not strictly liable because somebody gets sick. You're strictly liable if you owed a duty to that person and failed in that duty. Well, your duty is to take reasonable precautions. And those reasonable precautions should insulate you from potential liability. So my recommendation is you look at these. I would go back to the WSC website and pull that list off and literally print it out and keep it on your desk. It's a very, very good primer on what you should do. If you do those things, the majority of those things, you'll be in compliance with both OSHA and CDC rules. Next slide. I also want to make sure you know what happens if an employee shows up sick, wants to come back to work, you have a little temperature and you've got a temperature, or they're showing signs of having some type of flu or COVID-19. And the differential between the two initially is not going to be a lot different. They're going to have a fever, they may have a cough, they may not feel good, they may ache a little bit. They could have either one. You send them home immediately. Make sure the employee gets tested. The EEOC allows you to send people home and require testing so long as it's not discriminatory. You're not doing it only for certain types of people. And that includes those with disabilities. I would vacate any area they did and clean it. The CDC has recommended if you could leave it unoccupied for 24 hours, if possible. So if you have some area, it's somebody's office, and you don't need that office that day, you can do it. Just to have it cleaned and disinfected, and then wait 24 hours before you do it. You need to identify and notify all employees and customers that contact with that employee who either showed the signs during work or had already been at work. But do not use the employee's name, because that violates the law of privacy. So you need to let them know. Now, in all honesty, if you have somebody who's sick in a warehouse and all of a sudden one of your 10 warehouse people aren't there the next day and you tell somebody came out with symptoms of the coronavirus, I think they'll all figure out who it is, but you can't name them, okay? You need to check to see if you need to report it to your local health authorities. Some require it, some don't. It may be worth doing it anyway, because over time they're going to want this information to be able to track this to prevent the spread of it. And you got to take these precautions, because if you let this person stay, you don't properly clean after they leave, you don't allow your people to know that there was a potential exposure, you may end up finding yourself liable for if the spread of COVID-19 happens within your facilities or because of your facilities being open. Next slide. Bringing employees back to work. This is a question I get probably daily. A lot of employees don't want to come back to work. They're literally making more on unemployment right now than they are on their normal job. Good example, New York. I think the unemployment max is $405. Plus the $600 means they're making over $1,000 a week. If they're at the absolute max in New York, you'll make close to $55,000 a year on the average. It's not going to last 55, all 52 weeks, but that much. That's a lot more than some are claiming. They don't want to come back. What do you do? How do you deal with it? And there are also going to be people who don't want to come back, going to claim the excuse, well, I'm afraid. I can't come back. I'm afraid. Remember a couple of things. One, this will impact the amount of your PPP loan forgiveness if you have one, because you have to spend 75% of that loan on employee costs, payroll costs. And two, you have to have the ratio of the average number of employees during the 8 weeks that you paid for, have it's called the equivalent of full-time employees. So it's the amount of full-time employees you have, plus if you have 4 employees that work half-time, that adds 2 more employees. So you have to have the equivalent of your full-time employees is going to be compared to what you had prior to the loan. And they look at either last year's early part of the loan or the first 2 months of this year. You get to pick which period you want to be compared. If you are below those numbers, you're going to have less of the loan forgiven. So letting people not come back to work or not getting paid, you don't even have to make them come back. Remember, you can pay them without them coming back in order to take advantage of this PPP loan forgiveness. If you don't pay them and the numbers are low or less than 75%, you're going to have less of that loan forgiven. It can also impact next year's unemployment insurance rates because they're going to be on your list as unemployed. So what do you do if somebody doesn't want to come back? One, you can report it. And in some states, you're required to report it. They'll give you a form every week, and you have to report who's out of work, who's getting unemployment, and you have to tell them whether they've offered a job back. But in many states, again, I'll just use New York, because we've just been dealing with some folks up there, you don't have to report it. But you can, but I don't know if you want to report it, have their unemployment taken back, have them come back to work. They're going to be a very happy camper, I'm sure, if they're now going to be allowed to make less money working than they were beforehand. You can also bring them back part-time. In some states, that'll actually mean they make more money by working a few days a week, plus their unemployment. In a state like Texas, for example, the first 25% of their unemployment will be unaffected by them in coming back. After that first 25%, so say they're getting $400, the first $100 will be given to them, plus then any dollar for dollar off of that they make. So if they make another $200, they'll lose $200 of their $400 benefit. Plus they still get to $600. So they'll actually end up with $1,100 for that month as opposed to $1,000 for the month. So you can do that. Other states like New York are less forgiving. New York says if you work more than 3 days a week and make more than $405 during those 3 days, then you're not eligible for unemployment. If you work 1 day, they take 25% of your unemployment away, whether you work 1 hour or 20 hours. So be aware of that as well. The other aspect is you can simply say you don't want to come back, you're terminated and hire somebody new. That's particularly attractive if you really have no work for these people immediately, because when this thing passes, there's going to be an awful lot of folks that did not survive this economic and health crunch and crises, and you may find good employees available for you. So you need to think that's a business decision, but you need to think of it. Next page, Louis. I also want to remind you is that it was really easy in the beginning when the Families First Act came and it mandated you provided 2 weeks of sick pay and 10 weeks of family leave under certain circumstances, because the Department of Labor said you only have to pay those if you have work for them. So if you were in a shelter-in-place order and you couldn't open up, you didn't have work for it. Or if your business had died down, you didn't have work for it. Well, now that you're bringing people back on as you start to open up, you may have work for them. And so that may come back into effect. So if somebody is required not to come to work because they have a doctor's order saying they can't come to work, they have a heart condition, they're diabetic, they're on an autoimmune disease issues, then you're gonna have to pay them 100% of their salary up to $511 a day for 2 weeks. If they're sick and if they say I have symptoms of it, you have to pay them 100% up to $511 a day until they get tested. And then if they obviously test it, then you have to continue till the 2 weeks. If they're caring for somebody sick in their family, they get 2/3 of it up to $200 a day. If they're caring for a child because of no school or daycare, they get 2/3 of the pay up to $200 a day for these 2 weeks. Remember, as you bring people back on, this is going to come back into effect because now you may have work for them, where before it was unlikely you did. Next slide, Louis. There's also the family leave portion. It's 12 weeks of family leave if you're taking care of a child because there's no school or daycare. The first 2 weeks are covered by the sick pay, the next 10 weeks by this rule. If you're under 50 employees, remember you can get an exemption. You need to document that exemption. But be careful. You do not want to say, I'm not going to bring anybody back who has a child because then I have to pay the sick pay. Doesn't work that way. That's called discrimination. So just be careful what you do. Okay, next slide. With that, I open it up to questions, and I appreciate the opportunity.
Jeff, we have quite a few that have already come in. I remind you, if you're with us, just to post your question in the Q&A section at the bottom of the screen. And Jeff, before I get to these questions, I'm mindful of the fact that we have many of our installation professionals joining us on this call through CFI. And so they may not have been on a call like this before. So as I'm looking through these questions, getting ready to ask them, could you give specific advice to those who may be subcontractors? And what do they need to do during this time?
If you are a sole proprietor or an LLC, then you have special rules for your PPP loans. You can get your PPP loans. There's two programs that you should really be aware of. One is the PPP loan program. You're allowed to get it. If you're a sole proprietor, you basically give them your 1040-C form, which is the basic form. This is what I made. These are my expenses. And the bottom line, I think it's line 31, tells you your gross, your net profit. And that's the number you use to apply for your PPP loan as a sole proprietor. If you're a subchapter S corporation without employees, it's essentially the same thing. It's how you elect to be tested, whether you elect to be taxed as a sole proprietor. If you're an LLC with just yourself as an employee, you're generally going to be a sole proprietor. It's exactly the same process. If you elect to be done as a partnership, then those rules apply. But essentially, it's looking at that. If you're an LLC, you get the same thing if you're a sole proprietor. But if you have employees, or if you're a partnership with employees, you basically do the same thing. It's just different forms you have to add in. So you get to take your salary up to $100,000 and all your employees' salaries up to, payroll costs up to $100,000. And then you get to utilize that. So those loans are available. The second loan is the pandemic unemployment loan. Generally, if you're self-employed, you're not eligible for unemployment insurance. You don't have an employer who pays into the process. The federal government has extended that to self-employed and generally people who are not normally employed. So if you're a sole proprietor or an LLC, you are self-employed by definition. So you can apply for that, and that gives you unemployment if you have no income coming in or a lower income. It doesn't have to be 100%. It's a state-run program. Most states do not require that you have no employment. It's that you're making less or below their limit on unemployment. So in New York, if you're making less than $405 a week, you will be getting, it's actually half of that. So if you're making less than $810 a week, unemployment is half of the amount that you're not making. So you can apply for it if you're making less than you normally make, at least worth checking it out. So everybody who's an LLC or a sole proprietor and they don't have income coming in of any kind, real amount, they should apply for unemployment insurance as well.
Great. Thank you, Jeff. I thank you. If you're one of our installation professionals and are on, we thank you for joining us. CFI is very aware of your challenges and is trying to communicate everything we communicate to our overall membership directly to you. So if you go into the CFI site, you'll see links that will connect you directly back to the WFCA site where all of these answers can be found. We also are planning on doing a Zoom conference just for our CFI side somewhere in the near future. So be on the watch for that. And I'll get into these questions. So Barry asked, I just found out that I'll receive the PPP loan. Barry, this is a great reminder. Right after this, Louis, I'd like to do our second poll question that relates to the PPP, but let me finish this one. I just found out that I will receive the PPP loan and it should fund the end of next week. I have payroll tomorrow, May 1st. If my employees agree to let me delay the payroll until the funding is complete, would that be considered doable for PPP regulations? Also, can I pay my rent in advance within the 8-week time frame for the month following the 8-week period, which would be August?
This is not an easy question to answer, number one. But my reading of the statute and the regulations are this. You can't delay the payroll. Generally, it's the payroll incurred and paid within the time period. Utility costs and rent talk about the statute reads incurred and paid during the 8-week period. The regulations read paid during the 8-week period. I would not take this gamble. I would basically pay my employees when they're due, starting with the beginning of the loan. So the first day you get the loan is when you start covering your payroll costs, number one. Number two, I would pay only the rent that you paid during the period. You're going to get, you should on the 8 weeks, if things fall in correctly, get 2 rent payments in, assuming you're paying monthly, and you should get 8 payroll periods covered. I know some of these loans will come in the middle of a payroll period. The answer is you're going to have to allocate it accordingly.
All right, thank you, Jeff. Lewis, I'd love for the second poll question to go, because I assume a lot of these questions are going to be about the PPP loans. So our second question is, have you applied for the PPP loans? And the second one is, if you have you received your loan? If you take just a moment to respond to that for us, we would greatly appreciate it. And as that question is up there, I'm going to move on to the next question. Jay asked a question that's quite common. It's a really good question. Are all payroll taxes forgivable, or only certain portions?
Only certain portions. The only thing you can include is the state taxes that are paid upon the employment amount, which is generally almost always just unemployment insurance taxes that you charge to your client. All the other things have to be taken out. So if you're applying for your PPP loan, you're going to take any payments you made for healthcare, any payments you made for any retirement benefit, any payments you made for these state employment taxes, which is generally unemployment insurance, and that gives you one number. You're then going to take their actual salary, add that to it, and then you're going to subtract from that the amount of federal income tax and your FICA taxes that you paid. And that'll give you your total amount that is your portion of the tax that you paid. That'll give you the total amount. You don't have to take out their FICA tax amount out of it. It's just the federal income tax you take out. I think that's my recollection on it. So it's not only taxes that are forgivable, that are included in payroll taxes, in essence, are the payroll taxes that are state payroll taxes, which again are generally just unemployment.
Just like the government, to keep it simple, Jeff. We appreciate that. It can be
too simple. You wouldn't need me.
True. There's not a lot of simple in this.
Hey, Scott.
Yes.
I'm sorry, this is Lewis. I'd like to share the results of that poll.
Yeah, please.
So it looks like majority of the people have applied, and a good portion have received their payments.
Fantastic. That's good. It'll be interesting, and maybe webinar we'll ask if they applied in the first phase or the second phase, but we'll hold that for later, because we have quite a few questions coming in, and keep them coming, folks. This is great. Doug asked, does the WFCA have virtual training for flooring mechanics? Be a great time for installers to learn. We agree with you, Doug. I can tell you, I talked to Robert Varden just yesterday. They're developing some videos right now. We don't have that through the WFCA. When we have that, it will be provided through CFI, but we are very aware of the need for that and are moving on it as quickly as possible. Here's a question, Jeff, for you. If there's money left over after the 8 weeks, we obviously have to pay that portion back. But then at that point, can we use the money for other business-related things that are not payroll-related?
At the end of the 8 weeks, if you have money left over from your PPP loan, it becomes a loan for you at 1% interest and for 2 years. You can use it for rents, utilities, etc. But I would not think about using it to buy down debt or any of that nature, because I think at that point they tell you the PPP loan can only be used for certain items, and those are payroll, and then these very limited rent, utilities, interest on business debt, and that's essentially all you get to use it for. Now, understand, rent and utilities may include, by the way, transportation costs, which could be your leases to your cars and such. And in fact, for the sole practitioner, the sole proprietor, the regulations actually specifically say that rent includes the payment on leases for vehicles that are used in the business, which I think would give an indication that they should be allowable in the other type for loans to C and S corporations as well.
Good. Jeff, Andrew asked a question, probably expresses a sentiment that's very common for those on this call. Why would anyone want to reopen their business with these new rules and regulations? Andrew, there's no doubt it's a challenge, but it is somewhat the new norm, at least for a period of time until people get their confidence back. And so we encourage you certainly to prepare to succeed in the new norm. If you simply wait until they lift all restrictions and you open your doors and function in business the same way you did before, there's a very good chance you will not succeed, because business will not be done exactly like it was before. And so we encourage you to please adapt to the new norms as they come your way, and in fact, try to lead, set new examples of what you can do and how you're responding, and let your customer base know what you're doing to make them feel safe within your establishment. Jeff, would you add anything to that?
We've had members sit there and say that they're still selling flooring, but then people are no longer coming to the store. They feel more comfortable for the person coming to their home, for example. We've had people get a lot of new business by simply saying, what a perfect time to redo your hotel or your rec center or anything like that nature, you know, when residential is going to be difficult right now. People generally don't want a lot of workers in their home, obviously now, but places that are shut down may be a perfect time to do it. And in most states, even under the shelter-in-place law, construction, not in every state, I don't want to overstate that, but in many states, construction is considered essential infrastructure development. So if you're dealing with a housing project that is not occupied, you may have real opportunities to get business there. The problem is you're going to have some problems with your supply chain. And remember, there was a wonderful little explanation this morning about restaurants closing in New York City and the effect they have on farms in Iowa, you know, in California, the effect they have on shipping companies, because one farmer makes, all he grows is onions. 85% go to restaurants in New York City. It means 85% business was gone. So you may have trouble with your supply chains and everything else, but look for opportunities. You know, at a crisis you can really do well if you don't sit back and just really take advantage of these. The reason we gave these rules about reopening was not only to protect you, but also to get you prepared. Because of all of a sudden, if the shelter-in-place rules are lifted, you'd want to be prepared to move immediately. You've gotten the mask you need. You've got the sanitation devices. You have already cleaned out the store and sanitized it in your warehouses, etc.
Yeah, good. Jeff, I will just reiterate something I said yesterday when you and I were being interviewed live, and that is, somebody will succeed during this crisis. Why not you? Some of the largest companies in America, General Motors, General Electric, Nike, Sony, all were formed either during the Great Depression or during recessionary periods in our financial markets. And so I challenge you to be one of the ones who is committed and determined to succeed. Next question, Jeff, for you comes from Jeff Johnson. Regarding the PPP and affiliates, are the affiliates restricted to entities or are individuals included? If individuals or minority shareholders would be included and they're not employers, does the SBA consider personal net worth of the affiliate with respect to qualification of the business requesting the PPP loan? That sounds very familiar, Steve Abernathy. You would be.
This is you want to have a statute made so it's a complete quagmire. This is actually the question to ask.
Okay.
This is the rule. In applying for your PPP loan, you have to reach the 500 person, make sure you're under less than 500 employees. You have to include affiliates. And affiliates are defined a number of ways. Essentially, it's control. That's the big issue. So if you have more than 50%, you have control of your affiliate, and you have to count their employees in your number, just for the qualifying for the loan, the 500 number. If somebody is a minority shareholder, but they can block action, you have to include them as well, their employees as well, possibly. It's a little more complicated as an individual shareholder because then you'd only include them personally, not anybody that they're affiliate. But if you have a minority shareholder who's a business also, then that business would have to be number of employees. Once you've done that, that just gets you past the 500-person threshold. Then the affiliates stand on their own. You only include the employees that are in your business. The affiliate can apply for their own PPP loans, assuming they qualify, and using their own individual income. So no, they don't look at the net worth of the affiliate. It has nothing to do with that. They look at the number of employees you have. That's the only time affiliates are considered in the PPP loan. I hope that makes sense, because this is not uncomplicated.
Yeah.
That question was asked, I believe, by one of our members, and it's probably a full and further explanation of it is provided there.
Yeah, so we probably have that on the Q&A section of the website. Jeff Frank asked, is forgiveness, and this is related to the PPP loan, during the 8-week period, is forgiveness an average, or is it a head count by June 30th?
We've heard conflicting information in this. I've read the statute, I've read the regulations probably 30 times, and this is what the regulation says. If the amount of the loan forgiven will be reduced by taking the average number of employees you have during the 8-week period, divided by the number of employees you had either February 15th through June 30th of last year, or January 1 to February 29th of this year. You get to pick which period. So let's say you paid for 10 employees, and during those periods you had 20 employees. That's what they'll use. They then multiply that number to the loan forgiveness. So if you had 10, you paid for 10 employees, but you had 20 during those periods, then you only get half the loan forgiven. But it's during the 8 weeks in which the loan is used. I know some people have talked about it being 60 days later at the end of the period. I've read the statute, I've read the regulations. I see nothing that would give that indication. It says the average number of employees, and it's full-time equivalent is what it says. So again, to explain that, a full-time equivalent is all your full-time employees, then take your part-time employees and you add them up to the 8 hours. So if you have 4 employees that work a quarter of an hour each, you get 1 extra full-time employee if they work quarter of the time. And you round up, you always round up. That's a big issue with this, but you always round up. If that's what you have, that's what you compare. And you compare the two. So it says during the average number of full-time employee equivalents paid during the 8-week period. That to me is pretty clear.
Jeff Fred asked, does this apply to independent contractors since technically they're not employees? I know you've responded to that, but there was some confusion early on because they kind of led professional flooring dealers to believe that they could count subcontract labor in it, and then that was clarified later. Do you want to speak to that?
Yeah, the statute itself is quite confusing. It's probably more information than you need to know. The simple answer is no, you do not include independent contractors that are paid under 1099 form. They're excluded from your payroll. They themselves can apply for their own PPP loan. The confusion arose because the statute says under the PPP loan, the covered period for the loans are February 15th through June 30th. And they include, payroll costs include, and it says include, and then they give the sum of these things, which we talked about earlier, your salary, your benefits, etc. They take all of that and they include that, and then it said, and in payments to independent contractors. The Small Business Administration read the end as or. You don't get to, it means you get to include your payroll people, but independent contractors get to include their own. They're not included in yours. And that's where the confusion came in. And there's a bunch of other parts of the statute that are a pure a priori of information. They just conflict internally constantly. But SBA has interpreted, you cannot include independent contractors. They get their own loans if they want.
Jeff Janice asked, is there a sample letter on WFCA site for insurance claim closure due to shelter-in-place orders and or COVID-19? Will you speak to what we're doing on a business interruption insurance? And by the way, that is available on the WFCA.org site.
We didn't give you a letter. We've advised everybody to apply for business interruption insurance with the understanding that most, if not all of you, will have it denied. The reason we did that is, one, I want it on file for you, okay? So that's number one, because there's a time limit in which you can make requests for this money under your insurance policy. There's time limits on insurance policies to file a claim. Two, there's lawsuits all over the place. There's already multiple class actions saying you have to cover this, insurance companies, even though they're claiming they're not covered because there's no, quote, physical damage to the facility that has closed it. There's arguments about that, and we can talk about that some more if you want. But and secondly, there is a federal statute now being pondered that will require them to pay it with some federal funding. And lastly, which we've been pushing very heavily, there are a bunch of state laws saying, wait, you can't have collected this money for business interruption insurance, whether separately or under their general liability policy, and suddenly say some technicality prevents you from paying it out now that they need it. And they're forcing them. We have put together a grassroots campaign on the website. Go on there, type in the word business interruption. It'll take you right to the link. Go under the COVID portion of the program, and it'll take you right to the link. You click on that, you type in your name and address. It'll automatically generate emails to your local representatives in every state, in your state, and your governor, telling them, one, if they have a statute available, it'll tell you support the statute. If there's not a statute yet introduced or a bill introduced in that state, it'll say, please introduce one. And it's automatic. And all you then is hit send, and it'll send out those emails with your name on it and address on it automatically to those letters are already written. The actual demand for the insurance usually is done through simply contacting your agent and just saying, I'm filing a claim, and they'll fill out the paperwork for you to file a claim. And they'll say, oh, it's useless, don't do it. Say, I want to do it anyway. Tell them you want to file the claim, and as their agent, they'll have to file the claim for you.
Good. Jeff, Daryl's just asking for some clarification. What's the difference between the Small Business Association's PPP and Main Street loan programs?
The Small Business Administration PPP loans are loans that can be forgiven 100% under certain circumstances. They're only covered the next 8 weeks after they're given. They're meant to cover mostly payroll for your employees. And if you do that and utilize the money as they mandate it, 75% towards employee payroll, 25% towards rent, utilities, interest on business debt, you're going to get it all forgiven. You never have to pay the money back. Main Street loan under the feds, they've freed up billions and billions of dollars to provide loans between $1 million to $25 million to small businesses. They've reduced the number of qualifications, but there's still more than normal, and it's a strict loan. I think it's a 10-year loan, can be short as 4. You negotiate a 10-year loan, and I believe it's 3.5% to 4% interest on the loan. But you can use it for the same thing. In other words, if you get an emergency injury disaster loan from the Small Business Administration, which they also have available for you, you can't use it for the same thing you use the PPP loans for. The Main Street loan program under the Federal Reserve can be used for any of those costs as well.
Jeff, I'll skip down to David Sinclair because he's wanting some clarification. Are the Main Street loans a loan that has to be run through your bank like the PPP loan, or is this straight from the SBA or the government? Any special rules for applying, or how do you apply for those?
It doesn't go through the SBA at all. It can, but you don't need to. It should be gone right through your bank. The Federal Reserve doesn't give loans out. They guarantee loans. They buy them, basically. And what they're saying is, if you give these loans out, bank, we'll buy them all from you. We'll take 100% of the risk. And that's what it's essentially the way it works. It's a little more complicated, in all honesty, but that's essentially the way it works.
Back on the PPP, for employees who requested and qualified for a leave of absence, are other payroll-related taxes deductible in addition to wages under the CARES Act?
If you're paying somebody for under I'm not quite sure which money you're talking about, so I'm going to assume you're paying them just on normal leave, not under the Family First Act. If you're paying them normal wages, you take all the other, just like any other wages, like on vacation pay. You don't just give them 100% of their salary. You give them 100% of their salary minus their payroll taxes, minus their income taxes, minus their state payroll taxes, minus their contribution to any health plan or retirement plan that you normally take out. So the payment is exactly the same, but it's based upon the amount you pay them and it's based upon those percentages. So, obviously you're paying them 2/3 of their pay. Their income tax is going to be lower on that. Their employee contribution to FICA and to the healthcare plan may be different on that.
And Jeff, I think we've hit this one before, but obviously if there's money left over after the 8 weeks, they realize they have to pay that back. But can the money be used for other business related things that are not payroll related?
Yeah. You can pay it back and then the loan is all forgiven, assuming you got the rest of it forgiven. If you don't pay it back, it just becomes a loan.
But at a very low interest rate, right?
1% for 2 years.
Yeah.
In some ways, you can't use it to buy back down debt or anything, but you can use it for the same purpose. You can use it for the next payroll. You can use it for the next rent payment. You can use it for the next utilities payment, vehicle leases and such. And then you don't pay anything for 6 months. The 1% runs, but you don't pay anything for the 6 months. And then when you start paying it, you have a year and a half after you start paying it to pay it back. But it's at a 1% level. So for many of you, it may be worth keeping it as just a pure loan. I don't know where else you get a 1% loan.
That's true. In the PPP loan forgiveness, Dawn asked, relating to transportation, what does that include? Does it include gas, repairs, loan payments, all of that?
It's not clear. The basic statute and regulations for most, the basic one, not the one for sole proprietors, sit there and say it includes transportation costs. It doesn't say what's included in transportation costs, but my instinct tells me it's whatever you get to normally deduct in your taxes, because that's generally going to be the rule applied. If I got to deduct it under my normal income taxes as a business expense, I should be able to pay it under this loan because it's part of my normal business expenses. But transportation is included under utilities and under sole proprietors. They actually also included under leases, which is rent, which they interpreted things but paid through a lease. So office equipment, anything you lease, should also be included in that. So if you lease your printers, if you lease your copy machines, those types of things, should be can also be paid for under that loan.
Yeah, thank you. I know there's a lot of questions and it's not real clear on the forgiveness part. Phil Kufadakis just sent me a message and he's provided a link that I'll have Jeff look at, and then we may potentially post that on our site. It's just a government link that gives clarity to that, because Jeff, quite frankly, could take the entire hour and respond to nothing but that. So let me move on, because we have a ton of questions, and this is great. We're glad to respond to your needs. If you're granted an SBA PPP loan as a sole proprietor, are you still eligible for unemployment insurance as a self-employed business owner?
You're not while you're paying yourself. So once you get that 8 weeks, once you get the loan and you're paying yourself during that 8 weeks, then since you're using 75% of that loan to pay yourself, you're no longer eligible for the unemployment. Once that 8 weeks is over, you can reapply for your unemployment.
What if you don't start back employees immediately upon receiving the PPP? So maybe 7 weeks instead of 8 weeks. Is it the numbers or the dollars of salary?
It's both. If you don't have to bring your employees back to pay them. Remember that. You can just pay them. This idea is to maintain the relationship between the employer and the employee, where the money gets funneled to them through you, to maintain those relationships. So when the economy does start to recover, you maintain those relationships and your employees come back to you. And they know they've had the faith in you've been faithful to them, and they'll be faithful to you. That's a concept behind it. Otherwise, it would just be a grant. It makes no sense. Why not just give a direct grant to employees? So you don't have to bring them back, but if you pay them. The way it's done is 75% of it has to be paid. Be very careful about overpaying people to sort of make up that 75%, because the other part of it is the average number of employees paid during the 8 week period. So you're going to take each 8 week period, you're going to figure out how many employees you paid for, So let's say you paid for, you didn't pay for the first 2 weeks, and then you paid 10 employees for the next 6 weeks. That would be 60 employees over 8 weeks. So it's not 10 per week. It's now a lower number, whatever that comes out to be. It's 7 point some employees a week. And then you compare that to what your prior average number of employees were during one of those 2 periods we talked about before, the last year's period or the beginning of this year. So it hurts you both. It could get hurt both ways. You have to make 75% of the total amount has to be paid on a payroll cost, and the ratios have to look the same of number of employees that are paid.
Okay, just another question on the forgiveness aspect. So after the 8 weeks, are they not allowed to pay off their vendors as part of the money that they've received?
No.
Okay.
That money is strictly for those purposes.
Okay. All right, good. Here's one from Charles Buchanan. He says, we paused our 401k matching contributions previously. If we start matching during the 8-week forgiveness period, can that be counted toward the forgivable payroll expense?
It depends on when you stop doing it. I'd have to go back and check the exact time, but basically they're looking at, I'd have to look at this because this is an unusual question and I want to give it a little further thought. But my recollection is if you weren't taking the deductions as of February 15th of this year, then you can't take them during this 8-week period. But I want to look at that closer. I know that's true for rent. I know that's true for utilities. So in other words, if you can't enter into a new lease that you weren't paying for in February as of February 15th in order to use that as part of your payroll period, part of your loan issue. So I can't take on another store and get to use that as part of my rent as well. Or, I own my own facility, so I decided to rent it to myself so I could utilize that money as a rent. You can't do that. I'm not sure about the 401k matching funds, but it may have the same rule that if it has to be in existence as of February 15th, but I need to look that up. I don't know off the top of my head.
What about payments on an existing purchase of a car, not a lease, but payments on an existing purchase? Is that covered by the PPP?
If only the interest probably would be covered, but I'm not 100% sure. It's the utilities include transportation costs. You could argue that simply means costs for you to transport goods, not things you own. It's not clear. It does include lease payments. To me, it should include, the problem with paying it on your principal is while that may be a business deduction, that is, you're getting that deduction. You're only getting the interest portion of that is deducted. The other part of it you're taking as depreciation on the car or the vehicle. And so I think it would only be the interest payment for that. Again, that's a unique question. I don't think that's anywhere you're going to find in regulations. But at this point, I talked to your accountant, but my instincts tell me that only the interest portion of that payment would be able to be paid for out of this loan.
All right, Jeff, does it matter that your business was not totally shut down and that you were able to maintain 75% of your normal revenues? Are you able to use your PPP anyway?
The answer is yes, but remember, when you get your PPP loan, you're signing a declaration, punishable as a felony, that you were adversely affected by COVID-19 pandemic, and therefore you needed this money to maintain your employment. So just be cognizant of that be careful that is done. They've increased in the new round of loans. They've increased the requirement of those, what you have to verify. And they've said if you had done it under the prior loan program, then the new rules do not apply. But be careful on it just because you're going to have to prove that one, you use this money for it, and two, they can come back and say, did you really need this money?
All right, thanks, Jeff. I'll remind everybody we're closing in on the 1 hour. We'll continue to go on and answer questions as long as Jeff is available. We are also, Louis, I'm correct that we're recording this?
Yes, we are.
All right, so this is recorded. We'll have the answers available to you on the WFCA.org website. So if for some reason you are not able to stay with us, then you will have access to this information anyway. how do you deal, or how are they going to deal? This is kind of a speculative question, Jeff, but I'll ask it anyway. How do you think that they will deal with sales pros and installers who have an inconsistent payroll from one week to the next?
This is a question I've been asked before. You actually go on WSA website. We may want to take those questions and answers, break them down a little easier for people to follow, but this whole question is actually answered there. They're generally going to look at your regular rate of pay concept. When you deal with installers, if you're paying them by piecework, there's a whole complex way of determining their regular rate of pay. So you can record overtime. To me, I don't think anybody's ever going to object to this. If you pay it, when you calculated your payroll cost as it relates to the amount of loan you got, you took the amount of payroll you had with all those other items added in and the other items subtracted out. You took all those costs and you multiplied it for the year and you divided it by 12. That gave you your average monthly cost. You multiplied that by 2.5. If you have your sales pros and installers back on, but you don't have sufficient work for them, you could probably get away with paying them the average they were paid last year. Otherwise, pay them what they would normally make, but you're going to have trouble making the 75% rule. So I leave that. There's no clear answer on this, but I don't think anybody, the whole idea is to maintain employees' income, and so they don't need unemployment, and so they continue their relationship with you as the employer. It would make little sense that if somebody is working on a commission or a piecework and they're installing two floors a week, the income is going to be so low that they're actually going to qualify for unemployment anyway. So the answer is it's up to you, but I think you can get away with finding every installer and every commissioned employee what was their average weekly income and pay them on that basis. And I would do that on the average, whatever the number you use to come up with your average monthly payroll. Most of you will have looked at just last year's payroll and calculated it. So whatever each employee, whatever was their average payroll, pay them that, and you probably can get away with that. I don't want to guarantee anything because this is not answered in the rules or the regulations.
Yeah, and Jeff, I'll remind those that are with us that oftentimes the guidelines are passed after the legislation is passed. There's a lot of clarification that comes even after it's voted on. And so that's the reason on some of these, we're still waiting for some clarity. And that's why Jeff is giving you a broader answer. Here's two questions from Maria, and they both relate to forgiveness on the PPP, but they come from opposite sides. So the first one is, what if we spend 65% of the loan versus 75%?
The answer is then you'll get less of it forgiven.
Okay.
I don't know if it's going to be 10% less, or this is complicated because they've not clarified this. It could also be you take the 65% divided by the 75%, and that's the amount of reduction in it. It's not been totally clear on that, but I suspect it's going to be the 10% less. So 10% of that loan will now not be forgivable.
What if you go the other way, Jeff? What if you overspend? What if you spend 85% of the loan versus 75% on payroll?
I don't think that's going to matter so long as you can justify why you spent that much more. That's an unusual thing to do because the idea is payroll protection, which is maintaining payroll. So if you spent more on payroll for that reason, there could be reasons you do that. Don't get me wrong. But you're going to need to justify the fact that, and it could be because the number of employees you had at the end of the year were much higher than the beginning of the year. Mm-hmm. So your average payroll cost was based upon 10 employees you had. Yet at the end of the year, by the time you actually calculate the employees you have that you want to maintain and pay, you had 15 of them, and you paid all 15. That's a clear justification. Don't get me wrong, but if you just start to pay people more money in order to get above that, you may have a problem.
Gary asked a good question that we get quite often. Do we need to appeal if turned down for the business interruption insurance? Because as you've already noted, they probably will be turned down. Is there an appeal that's necessary?
That's a tough question. I'd have to look at everybody's individual insurance policy. You need to look at them. I'd talk to your agent about it, ask them if they need to file an appeal. I would hope not. I think I'm almost certain within a reasonable, again, it depends on exact policy language, so I don't want to overstate this, but I think it would be unlikely you would have to do it.
Okay.
But it is a possibility that you would have to. The best way to do it, the agent should be helping you, not helping the insurance company. They're selling you insurance through that company, but they actually are representing you. That's easier said than done.
Yeah.
So I have an agent that is probably so darn independent. He'll tell me ways to get my insurer to hurt, to make sure I'm whole, because he realizes I'm his client. And then there are some that sit there and say, well, my real business, and I'm getting paid by, Prudential. I'm not going to go against them. But just ask them and then document everything. So send an email out. Thank you. I understand I don't have to appeal this. Or thank you. I understand I do have to appeal this. Could you please start that process? That's all. And if they don't do it, then it's on them.
Thanks, Jeff. Bob asked, is there a way to know what area of the country the dealers are located in that have received their funding? Lewis, that's probably actually a question for you. I don't think there is, but I think he's responding to the poll that we had of the people that said they had gotten the PPP funding. Is there a way to know where those people came from?
We did not ask for the state they're in or locale. So no, we don't have that information based on that poll.
Okay. All right. Thanks, Lewis. Andrew asked, has the issue of workers' comp been addressed in the PPP? I pay about 12.5% for my installers and warehouses. Is that included in the PPP?
No, it's not included. However, your employer, any employee that gets sick may have a workers' comp claim. Insurance companies are going crazy over this because they believe there may be a $30 or more billion loss in workers' comp this year because of the coronavirus. So so in other words, people can get, if they can't work because they have contracted the disease, they can file a workers' comp claim in most cases. So it's been a big time issue, and their states are mandating, some states cover these types of illnesses under their workers' comp, some do not. There's been bills in Ohio and other states that have mandated it be covered. You just need to check with your own workers' comp company of whether they have claim rights. But the cost of it is not considered part of your covered payroll costs.
Okay. You talk about forgiveness on interest of business debt, but I read interest on mortgages. Would interest on a line of credit or a credit card, for example, be forgiven?
Yes, it says mortgage or other business. I'd have to go back and read the exact language, but it covers more. It says mortgages, but again, it's not particularly clear, but it means mortgages, for example, on business facilities. I don't think you get to deduct the interest on your mortgage for your home unless actually your home is your business. So sure. And then not only that, it's going to be part of your portion. I mean, it gets more and more complicated. So, if you have, if you use your garage to operate your installation company, you may get you probably have a portion of your home is deductible as a business expense. That portion of that mortgage, interest on that mortgage will be deductible to the portion that you use your home. But generally, I mean business. But yes, it should be included on other debts as well. And that should include, line of credits and such, but only the interest, not the principal.
Jeff, Lisa asked, if I have 3 part-time employees that might work maybe once a month, do I have to pay them through the PPP? They all decided not to come in due to health reasons.
They may have decided not to come in due to health reasons. That doesn't mean they can't come in. You don't have to pay them. You don't have to pay anybody under the PPP loan. Okay. The question is if you look at your average number of people you paid, if it doesn't average out equal to or greater than what is on those prior periods, then a portion of your loan will be unforgiven. So if you have somebody working, part-time employees who work 3 times a month, I assume that's 1 day, that's 3 days. I don't know if that would at best add 1 extra employee to you, and it may not be a particularly big number for you. But you don't have to, actually, technically you don't have to pay any employees. You can pay some and not others. The difference is that it affects what portion of the loan is going to end up being forgiven at the end of the 8 weeks.
A good question here from Jerry. He says, is there a way to get consideration in employee number averages for being unable to get employees to return to work for competing high amounts from unemployment benefits, COVID fear, COVID illness, etc.?
The answer is no. You can replace those employees and use that new employee, or even you can hire temps and do that. Those temps may affect your other employees. If you've offered them their job back or offered them payment, may affect their right to continue to get unemployment. If they have a fear of COVID, one, it has to be reasonable and it has to be supportive. So the fact that you just have a fear, my wife and I were talking about this the other day, and she was saying, what about these people who are really concerned when they're talking about the meat plants having to be reopened? And I said, if I had you come back to work and I said to you, don't worry, we're sanitizing the entire equipment, we're taking on 3 shifts instead of 2 so we can spread out our workers more. We're giving everybody gloves, masks, and with sufficient quantity to change on every break. We're staggering the breaks. We're cleaning every piece of equipment between shifts and blah, blah, blah. If I told you all of that, would that fear be as reasonable? And she said, no, and that's the same thing here. So it has to, people don't want to come back because they're fearful. I understand that it's a horrible situation, but it puts you in a bind of being kind to these people who have an unreasonable fear, notwithstanding you took all these precautions, and you having to pay that price because you're not going to get as much of your loan forgiven, and it could affect your unemployment rates next year. So it is a dilemma, but there is no way of getting around it. They're going to look at the number of employees. Again, the alternative is to hire new employees or temporary employees to fill in that gap to get you to the 75% and get you to the numbers you want.
Jeff, Linda understood you to say that utilities included transportation. Is that what you said? Because she's saying she can't find that anywhere.
Yeah, it's right in the statute.
Okay, it is in the statute.
I can look it up if you want. I just didn't want to interrupt to look at some of these questions up. But in the statute, it says that it talks about utilities, and it puts in parentheses, and it says electric, telephone, gas, water, transportation.
Okay, cool.
It may have some others. I just don't recall them off the top of my head.
William asked about one of the other common loans that we're asked about. What are the guidelines for money received from the EIDL grant of less than $10,000?
The EIDL grants, which is Emergency Industry Disaster Loans, they're actually loans. So you apply for this loan. It has to be for utilization for something other than what you're getting a PPP loan for, or you can't apply for both. You can apply for both if they're for different issues, okay? Once you apply for the loan, within 3 days, you're supposed to get an immediate $10,000 payment. Maybe that should have been the poll question. Has anybody applied for it and actually got it within 3 days? Because at least initially, we weren't seeing 3-day rule apply. If you don't end up getting that loan, that $10,000 is forgiven. But let me tell you something. When you go to get your PPP loan reduced, if you got one of these loans and had $10,000 forgiven, they'll take that as part of the forgiven portion. So let's say you have a PPP loan for $100,000. I'm just going to use these numbers. You read all the rules that are perfectly done. You've got everything. It's 100% should be forgiven. But you also had the $10,000 forgiven under the emergency disaster loans. Then that $10,000 would still be considered part of the PPP loan. They count that as part of the forgiveness program. If you do get the loan, then the $10,000 is just included in the loan, and whatever the terms of that loan are, which is usually going to be about 10 years, at a low interest rate, I think about 3.25% to 4%.
Yeah. Another question on the forgiveness. Stephen asked, my question is concerning PPP loan forgiveness and employee compensation. I've read that employees must be paid at their current rates. This would work great for salaried and hourly employees, but how do you deal with those like salespeople who are paid strictly on commission? Is it on average?
Yeah, again, this is not clear. Since payroll calculation to get your loan included all commissions, tips, bonuses, etc., there's a strong possibility you will not quite make the 75% normally. And if you were paying strictly on commission to employees, you're with a guarantee, obviously, under the law. All you'd pay is a guarantee if they're not working, and it would be well under the 75%. So what we've recommended, since you built the loan off of their average from last year, apply the average to compensate them this year. Because the purpose of the loan is to maintain payroll. Again, remember the PPP stands for payroll protection program. It's not give money to small businesses. It's payroll protection program. And it's why 75% of it must be paid for payroll costs, and why they do that ratio of how many employees you're paying for.
Jeff, can cable and telephone bills be paid for from the PPP?
I don't know about cable, but telephone bills can be. It depends on what the cable bill is for, but certainly internet services can be.
Okay. Janice asked, has anyone done a calculation paid to commission-only salespeople? Kind of related to the question you had before. How does this relate to employees no longer on payroll but still receiving residual commissions? Are they considered full-time employees?
I've not seen this question before, and I'm absolutely not sure the answer. So I wish I could. These are weird. The answer is they're not employees any longer. And you're simply paying the commission. I would actually include them in, but you're going to have to. They may not count in the count number, but they'd count towards the 75% number.
Okay.
And that's a tough one to give. So I think if you're paying them, you may want to sit there and see, how do I include them in the count number? They're no longer full-time employees. I'm not paying them as a full-time employee. I'm not even paying them as a part-time employee. I'm paying a residual out to them. Now, those residuals are paid out based upon income from jobs, and you're not getting that income any longer for the moment, then you don't have to pay them at all. But if you are getting that income, then you have to pay them out of that money. The argument is you can pay them out of the money getting on that income and then not include that in the payroll loan. But it's either way you're going to do it. I think you can include it on your payroll cost. I think the problem is going to be whether they count in as full-time employee equivalent.
So she goes on to ask, what if in the current scenario, the salesperson is only receiving draw payments, which could be less than they earned previously? How does that 25% reduction that they pay play into that? Because she notes that they can be penalized if decreasing pay by more than 25%.
Well, again, the answer is that that's a difficult question. The idea was to maintain payrolls. That's why they gave the loan program. Obviously, if somebody's paid based upon business, whether that's a piecework payment or whether that's a commission payment, they're hurt because they're not getting payroll. They may well be eligible for unemployment because they're being paid so low, depending on your state unemployment rules. So the simple answer is that you can pay them based upon, I believe you can pay them based upon your average. I would check with the bank that you got your loan from, but I can't imagine the bank saying anything but, yes, you can pay them based upon their average payroll from the prior year that you used to calculate the loan.
Okay. Keith asked, what will be the forgiveness application process? I think this has not been clarified yet, Jeff, but he says, will it be lender driven or SBA driven? Because when they got their loan, they understood it wasn't based on need.
Yeah, when they got their loan, it was not, well, you had to sign an affidavit based on need. That you did have to do. But it wasn't on the sense that I needed. You had to say that I'm affected by it. You know,
Okay.
and the answer is that there's no business in this country that wasn't affected by it, even if their business didn't go down, because they would be affected by it in the long run. So, you know, the answer is everybody who could apply should have applied. The process will be dictated by the SBA, but the process will be done through the banks, is my understanding, is how it's going to be. So you're going to go back to your bank to give them the documentation for the forgiveness of the loan, who will then give that information to the SBA under a process that they have devised. So this is you deal directly with the bank deals with the SBA. That's how it works.
Okay. Next question from Marty Cohen. Marty, hope you're doing well. He's just looking for some clarity here, Jeff. He says, just want to clarify, is it true that the amount of the loan is not part of the forgiveness, that is not part of the forgiveness portion, can still only be used towards the same requirements as the forgiveness requirements, payroll, state tax, health insurance, rent payments, and utilities, and is still at the 75-25 ratio? Is that correct?
The answer is yes and no, depending on which part of the question you ask. The first thing is, remember, the payroll, the CARES Act, which established payroll program, the PPP program, has two parts to it. One is the establishment of the loans itself, and the second is the forgiveness portion, okay? The statute itself says you can only use the payroll loans for these items, and that's the payroll costs, utilities, interest, etc., okay? Rent, etc. Only those items that we've repeated on. It would have, under that language, if you haven't pay, if you don't get 100% forgiven, you still can only pay it for that. But it doesn't any longer have to reach the 75-25 ratio. So let's say you get 50% of the loan forgiven. That other 50% will become a loan. So you get a $200,000 loan. The other $100,000 is a loan. After that, you can use that loan to pay future rents, utilities, cost, payroll, whatever proportion you want. Because now it's just a straight loan, but it still is restricted to what you can utilize it for. But it's not subject to the 75-25 rule any longer, as I read the regulations and rules.
Jeff, the next question comes from Maria, and she's really referencing the $100,000 cap. Part of our payroll for these 8 weeks will be commissions. How does that affect the $100,000 cap? Do I calculate year-to-date income and cap it?
Yeah, you have to cap it. Okay. So if you have commissions and that person makes 100, is on the average making $150,000 a year, what you get to count towards the payroll is only the amount for the 100,000, which is, you do your own math, it's what, 8,000 some odd dollars.
Okay. All right. Eddie, this is a good question. Eddie Duffy asked, can you include additional costs for employee protection to meet the new OSHA and COVID-related requirements like mask, temperature equipment, gloves, etc., not included previously when pricing open projects? So they have to go back to open projects they've already bid, and now they're having to add in additional costs because these requirements are now there.
That's a contractual issue. You can go back and ask your people on that. There are ways of arguing for that. There's a whole bunch of different issues. Obviously, there's the force majeure. Something's changed that has prevented me from doing this contract the way we originally planned it. There's fees. There's a whole bunch of common law doctrines on contracts that allow you to go back and say this was an unanticipated problem, and that we need to make an adjustment. But that's a pure contract issue. I'd have to look at your contracts. I'd have to look at your state law that has these implied rights to you. There's a feasibility right. There's a whole bunch of aspects to contracts that are allowed to be done. It depends on how severe the costs are. It depends on how sympathetic a court is. But the answer is, if you have these additional costs and you have open contracts, immediately contact your customer and say, I know we bid this at this way and we'd agreed to it, but be aware of it is that given COVID-19, we have additional costs that we have to, I'm not going to make a profit on, but I at least have to pass through to you. And that, talk to them now. There's a very bad old joke of a woman saying, I had 20 years of wonderful marriage, and then my husband started to talk to me. The reality is it's exactly the opposite. If you communicate with people early and often, you can solve your problems. It's when you spring it on them that's a problem. Everybody is right now in this kumbaya moment of, oh my God, we're all sheltered down. It's irritating. It's, we're trying to help everybody. There's at least some aspect to it. Deal with it now. Tell them, and they'll say, well, what's going to be the cost? And say, I don't know how much it's going to be, but we have to do all these we have to do all the sanitation, all of our installers now have to come with masks. They have to come with gloves. They have to have changes of them. We have to provide sanitation systems for them, et cetera, et cetera. And there's going to be some increased costs. If you can estimate what those costs are, just tell them what you think the estimated costs are and agree to it now before the project starts and before this kumbaya moment leaves when everybody recognizes they're in this together. I'm not going to guarantee it works, but boy, it's better than just trying to spring it on them.
Yeah, true. Jeff, if they hire new people during this 8-week time period, is there a length of time that they have to keep them on after that 8-week period? Is there a regulation requirement on that?
No, but the employees themselves are going to have some issues with that. So if you're hiring them, you're saying, listen, I'm grabbing some people up for part-time work. For some short-term 8-week work. You've done this before and things. Are you guys interested? Alternatively, go to one of these agencies that are being, that provide temporary aid help. You can go to them and see if they'll give you the people you need.
What if the head count matches the before COVID head count, the total payroll also, but the money is allocated to employees differently? Is that forgiven or not? Are they going to check every single employee average? And if so, how can you justify new employees under this rule?
Well, I don't see how they can do that, because the reality is if you're comparing the total number of employees that you do during the 8 weeks compared to a different period of time, either the first 2 months of this year or the February 15th to January 30, June 30th of last year, you're going to have different employees in the period. Unless you have the most stable employee base, most of you are going to have some turnover. New people coming in, people going out. There may be some people you've had part-time that are now full-time. There may be some part-timers that have left and you've replaced with new part-timers. I don't see how they can, it has to be whole numbers. I can't see how else they can do this.
Okay. Doris is seeking some clarification here. If they received $85,000 for PPP and $10,000 for the EIDL, then the $10,000 is a loan and not forgiven and is used to reduce the PPP?
No. Let me make this a little clearer. If you applied for a PPP loan, you got 85 grand from it. Those numbers are fine. And you also applied for the emergency disaster loan and got the initial $10,000, but never got the emergency disaster loan. Then that $10,000 is forgiven, okay? But what that means is the maximum amount of the PPP loan that will be forgiven is $75,000. Even if you meet all the other requirements, 75% payroll, the proper ratio of full-time employees, all of that. The $10,000 then gets deducted from what can be forgiven under the PPP loan. So the max, if you got the 10 grand that was forgiven, it was a grant. In other words, it was just forgiven because you never went beyond that amount. Then that counts towards what the amount forgiven under the PPP loan. So you're going to end up at the end of that with a $10,000 PPP loan at 1%, which is still better than if you took it as an emergency loan, which is at 3.5% to 4%. Okay, that clarifies it.
Jeff, Gary just sent some clarification. He said, effective today, the FED has lowered the Main Street loan minimum from $1 million to $500,000 to $500,000.
Yeah, we thought they would be doing that. We just have not heard from it. We had advocated for it. We sat there and said, you know, while you and the federal government think $1 to $25 million is small businesses, I have people that, you know, $1 million is almost double their normal gross sales.
Yeah.
So we've advocated for that change. I still remember a lawsuit I did against the federal government years ago. And the opening line to an economic analysis by the government economist was, while $9 million is a trivial amount. Well, I guess when you look at billion-dollar budgets, $9 million is a trivial amount. I never thought $9 million is trivial. But so they have a very different perspective of what is small and big. They simply don't have a relationship to reality. So we've been advocating for this. I'm glad I did not see it this morning when I looked it up, and it's probably just I missed something or it hasn't come into through my mailbox yet. But we were aware that they were fighting for this. I didn't want to promise it until I knew, but thank you for bringing us up to date on that because that's really, really important.
Yeah, Jeff Johnson asked, what is the U.S. federal tax deferral program?
The deferral tax program is, I'm not sure which one he's talking about. There's a bunch of them. One is you don't have to pay your federal taxes for a while until I think, June 30th or what. I have to go back and look at the date. My taxes were in, so I don't know what the date is because I haven't personally looked at it very closely. But the other one is that you also have a credit program under the federal taxes. If you do not take or receive a PPP loan and you maintain your employees and you have a 50% loss in business, then you can take, and you continue to pay employees, you can take 50%. I'm going to have to go back through this because this is something we have not dealt with a lot because most of our people don't look at it. You can take 50% of that payroll cost as a tax credit, not a tax deduction, a tax credit. So if I have $100,000 of employment payroll costs or salaries, I get 50 grand of that as a pure tax credit. So $50,000 of my this year's taxes that'll be due next year, I've already been paid through that process. And that is until you reach 80% back to your business. So that it's a little complicated. I'd have to go through it a lot more deal. So if that's the program he's talking about, it's that program. There's also some other deferment programs when you have to collect taxes. There's a deferment on, you don't have to pay into your retirement funds immediately because of the low payroll. There's a mandated retirement withdrawal once you reach 70. You don't have to withdraw that this year, the minimum required amount. There's a whole bunch of different payroll aspects to it. They're quite confusing, and there's been a lot of controversy about the various rules. We've not looked at these in great detail because we've not gotten a lot of questions on them. I started to look at them last night because of some of the problems that are arising with the tax code that's on them.
Jeff, this one, Kitty's asking a question. There's actually maybe 3 different questions in here. It says, sorry if you've addressed this before. Part owner of a small flooring company in North Carolina. I have a funded PPP loan. I qualify with 11 employees. However, I have 3 who have left. They have not officially quit, and I've not fired or let them go. They just are not coming in. One man, his wife is concerned about him coming in. A woman has 4 kids, so they've got the stay-at-home situation with no school, so she has to stay home with them. And one man has applied for unemployment and is receiving it. How does she deal with those scenarios?
Okay, well, let me go through each one. I'll go through the hardest one first. The woman who's staying home with 4 kids because there's no school, and I assume there's no daycare available for her. There you're gonna have to pay her, but you're not gonna pay her out of the PPP loan. You're gonna pay her out of the Family First requirement. She gets 2 weeks of sick pay at 2/3 of her pay, and she gets 2/3 for the next 10 weeks as family leave. None of that counts towards the PPP loan because you're already getting a tax credit for that. Okay? So that's the first thing you got. That's the first thing. That one is easy. She's not in your PPP loan. There's nothing you can do. If she qualifies to get the paid family leave and paid sick leave, as we talked about earlier in the presentation, then you have to pay her that, and you get a straight tax credit. Every penny you pay for will become a tax credit for you, which are various ways to collect it. One is you get to keep all your payroll taxes you had paid out to pay off that amount. If that's inadequate, you get to apply to the IRS, and they'll pay you very quickly the difference in that amount.
Jeff, what about the one who has applied for unemployment and is receiving it?
It depends on what your state you're from, Kitty, but one of them is this. It's if you're in a state that requires you, and mostly it's every other week, for you to fill out a form of what employees you have on, and they'll usually list who are claiming you as their former employer and therefore getting unemployment. You are going to have to list to that person they were offered a job and have not come back. They're immediately going to get kicked off of unemployment. I don't know if you want them back at that point. If you're in a state that doesn't require you to report it, it's your choice to. But in order to make your loan more palatable, you may want to terminate that person and move forward with somebody else.
Okay, and the other one was the man whose wife is just uncomfortable with him working because of the COVID situation.
Well, you got to tell them that this is what I've done to ensure that we have covered you, to protect them against it. But it has to be a rational fear. Now, if the person is generally, if there really is a real risk, they have diabetes, they have a heart condition, they're on an anti-inflammatories that cause autoimmune diseases, like arthritis and such, they should have a doctor's note saying they can't come back to work. If that's true, then you're going to end up paying them anyway under the Federal Employees Health Program. If not, then just terminate them. They just can't have any, so long as you've allayed those fears by doing the proper things, cleansing things, providing safety equipment, monitoring employees every time. You buy one of those little $65 temperature guns. Everybody comes in, customers and members alone, you check on them. Everybody is asked to fill out a form upon returning to work. They have no symptoms of COVID-19 and they've not been around anybody who's had it. All of those are what you've done those precautions, that becomes an irrational fear, and you can terminate them for that reason. But again, that's a choice. You may not want to do that.
Back to the PPP, Bertha asked, we applied for the EIDL on 4/2, we received the $10,000 on 4/21, but no email or communication at all about the status of, I believe she's talking about her PPP application, not that it has been denied or approved. Does this mean our application is still in process and there's still a chance that they'll get the loan?
It's possible, but I'd check with the bank that you applied through, unless you applied directly to SBA, but just check it. You should have a loan application number. You should be able to go online, whether you did it through you probably did it through they're not a 7A banks, that's a 7B institution. I'm trying to remember the easiest way to, but if you're gonna, that loan number, you've been given a loan number, you would have gotten it with the $10,000. Just go online, plug that number in and ask, see the status of the loan.
Okay. Janice asked, and Janice had several good questions in here. She says, has anyone highlighted the accelerated depreciation component of the tax law changes? She says, this could, I think, allow 100% depreciation of any interior showroom upgrades that are installed in 2019 or 2020.
Yeah, one of the things I was looking at last night and probably will get out, I'd like to tell you tomorrow, but probably more likely over the weekend, is a whole explanation of that. This has been a big issue with the tax reform that took place back in 2017. It really hurt small businesses on depreciation. And we've been fighting to get this fixed for quite some time through myself and lobby it. And this appears to be part of the fix of that. And you're right, it's going to accelerate depreciation very well. And it allows you to go back as well. You're going to be able to apply it to your 2019 as well. So I just start to look at it. There's some confusion about it. The IRS regs are not very clear on it. And there's been some stuff that before I write anything, I want to make sure I have my handle on it. I'm not a tax lawyer. But I do understand the basics of this, and I want to make sure that I explain it to you correctly. And since there's so much controversy right now about some of the words of it, I want to see if those will get any clarified. So I hope to have it out to you early next week, a full explanation of this accelerated depreciation opportunity, because it is in the bill. It was put in the last, not in the last act, but the CARES Act before that.
Jeff, thank you very much. That's our last question. We've covered all the Q&A as well as the chat. Great questions today. We thank you for being a part of this and allowing us to positively impact your business going forward. Again, I remind you that all of these resources, much of what Jeff has talked about today, and if he talked about today and it wasn't on there already, will be updated to wfca.org. Please utilize that site and be looking for our communications that are blasted out as well. We typically have a webinar like this every week. Next week, we will not be able to have the webinar because we actually have our board meeting that will be taking place during that time frame. But be on the lookout for communication about the next webinar that we will have. And if you have additional questions in between, please feel free to email us and we'll do our best to get an answer back to you on a timely basis. Jeff, again, thank you for your expertise and your time. Clarity on everything that he's offered today is, again, provided on wfca.org. And we wish you great success as you prepare for success in reopening your business. Thanks for being with us.
Thank you.